If you have $500,000 in super and you're still in accumulation phase at 60, you are handing the taxman around $5,250 every single year for no reason. And your super fund will never tell you. That's because super earnings are taxed at up to 15% while you're in accumulation. 7% return on $500,000 is $35,000 in earnings. 15% of that is $5,250 gone every year. For 7 years until you hit pension age at 67, that adds up to over $36,000. Before you even factor in what that money could have compounded into. Most Australians assume they have to wait until 67 to start drawing a super pension. But the law says you can start at 60 if you've met a condition of release. And once you do, your fund pays zero tax on earnings. Not 15%, not 5%, zero. There are 5 legal reasons that Switch can put tens of thousands back in your pocket. We'll go through all 5 today, including one most financial videos never mention. A hidden catch that means staying in accumulation is actually the smarter move for some people. So don't skip the second half. If you're 60 or older and still paying tax on your super earnings, stay with me, because this could be the most expensive decision you haven't made yet. So here's how this actually works, and why it matters more than most people realize. When your super is in accumulation phase, your fund pays tax of up to 15% on investment earnings every year. That includes interest, dividends, and capital gains from selling assets within the fund. It's automatic. It happens quietly in the background, and most people only notice it when they look at their annual statement and wonder why their returns feel lower than expected. Now, once you hit age 60 and you've met a condition of release, the most common one being that you've left or finished a job after turning 60, you're legally entitled to move your super into a retirement phase pension account. And from that moment, your fund pays zero tax on earnings, not a reduced rate, zero. On a $500,000 balance earning 7% a year, that's a tax saving of $5,250 in the first year alone. Year 2, if your balance has grown, the saving grows with it. Over 7 years from 60 to 67, before you'd normally think about touching your super, the difference stacks up past $36,000. And that's before compounding. I've been there too. I switched my own super to pension phase at 60, and honestly, the tax savings in the first year covered what I'd been putting off. A proper trip overseas. It wasn't a windfall. It was just money I'd been giving away that I didn't need to. Now here's something worth pausing on, because I hear this confusion a lot. A transition to retirement income stream, a TTR, is not the same thing. If you've started a TTR because you're still working and want to draw a bit of income, the earnings inside your fund are still taxed at 15%. A TTR is not pension phase. You do not get the zero tax on earnings until you've fully retired and started a proper retirement phase pension account. The distinction matters because some people hear, I've started drawing from my super at 60 and assume they've done it. But if you started a TTR, you haven't made the switch yet. If you're 60 or older and still paying tax on your super earnings, hit subscribe. I cover strategies like this every week with real Australian numbers and no jargon. Now, reason number 1 is about your super growing tax-free. Reason number 2 is about the money you actually take out. And that's where it gets even better. Reason 2 is about the money that actually lands in your bank account. Once you've started a retirement phase super pension and you're past 60, every payment you receive from your super is completely tax-free. The full amount. No withholding. Nothing to declare on your tax return from that income. It doesn't matter whether your super was built from before tax contributions, after tax contributions, or a mix of both. Once you're taking payments as a pension past 60, the tax on those payments is zero. Put some numbers to it. If you're drawing $40,000 a year from your super pension, you keep $40,000. If that same $40,000 were coming from a part-time job, a rental property, or a term deposit, you'd be handing a portion back in income tax, depending on your marginal rate. For most people in that income range, that could mean $3,000 to $6,000 in tax on the same amount of money. Now, here's something I want to clear up, because it trips people up constantly. When I say super pension, I'm not talking about the government age pension from Centrelink. That's a completely different thing. Your super pension is your own money, the savings you built up over your working life inside your superannuation fund. A super pension is just the name for how you access that money after you retire. The two are separate systems. So at this point, you've got tax-free growth inside the fund and tax-free income coming out. That combination is genuinely hard to match anywhere else in the Australian tax system. But I know what a lot of you are thinking right now. If I start drawing down my super at 60, does that wreck my chances of getting the age pension later? That's reason number 3, and the answer might surprise you. Let me introduce you to Peter. He's 61, recently retired after 30 years as a teacher, owns his home, and has around $380,000 in super. He's single, and like a lot of people in that position, his first instinct was to leave his super untouched for as long as possible and hope the age pension fills any gap later. But here's what the numbers actually show. The age pension is means tested. Services Australia looks at what you own, your assets, and what your assets are deemed to earn, your income. For a single homeowner right now, the full age pension cuts out once your assets pass around $321,500. You can still get a part pension all the way up to around $722,000 in assets. Above that, you get nothing from Centrelink. If Peter keeps his super in accumulation and doesn't draw it down at all, and it grows at 5% a year, by the time he's 67, that balance might be close to $535,000. He'd be well inside the part pension zone, but closer to the top end, which means a reduced payment and a lot of that super sitting in a tax-paying accumulation account the whole time. Now flip the scenario. If Peter starts a pension at 61 and draws $30,000 a year to live on, which is a reasonable amount, his balance falls over time even with investment returns factored in. By 67, his super might be sitting around $210,000 to $230,000. At that level, he could qualify for a more meaningful part pension, potentially worth several $1,000s a year from Centrelink on top of his own super income. That is, money he would not have received if he'd left everything untouched. Now there's a wrinkle here worth understanding. Centrelink doesn't just count your super balance directly. They apply what are called deeming rates to your financial assets, currently 1.25% on the first portion of assets and 3.25% above that, and they treat those deemed returns as income under the income test. So it's not just about how much you have, it's about how much Centrelink calculates you're earning from what you have. This is why the strategy has to be calibrated. The goal isn't to drain your super as fast as possible. It's to find the drawdown rate that leaves you with enough super to last, while positioning your total assets at 67 in a way that maximizes your combined income, your super pension payments, plus whatever age pension you qualify for. For Peter, the maths points towards starting a pension now. For someone with $900,000 in super, the calculation is different. They may already be above the assets test threshold, regardless of what they do. It depends on your numbers. The point is that drawing down your super from 60 is not just about spending today. It can actively improve what you receive from the government system later. That connection is one most people miss entirely. Now, if Peter holds Australian shares inside his super, which most balance funds do, there's another benefit that unlocks the moment he moves to pension phase. And this one is a cash refund most people don't even know they're entitled to. Reason 4 is one that quietly adds up, especially if your super fund holds Australian shares, which most balanced and growth funds do. When Australian companies pay dividends, they often attach what are called franking credits. These credits represent the tax the company has already paid on its profits before distributing them to shareholders. The idea is that shareholders shouldn't be taxed twice on the same income. In accumulation phase, franking credits can offset your super fund's 15% earnings tax. But here's the issue. If your fund's tax liability is less than the franking credits available, which happens more often than you'd think, the leftover credits are simply lost. You don't get them back. In pension phase, your super fund pays zero tax on earnings, so there's no tax liability to absorb the franking credits. Instead, the Australian Tax Office refunds them to the fund in cash. Let's use Peter again. Say his fund holds $50,000 worth of Australian shares, paying a 4% fully franked dividend. That's $2,000 in dividends, plus roughly $857 in franking credits attached. In accumulation, his fund owes 15% tax on the $2,000. That's $300. So the credits offset that, and the fund gets back $557. In pension phase, no tax is owed, so the full $857 comes back as a cash refund to his fund. That's $300 more per year, just from that one parcel of shares. It's not life-changing on its own. But across a full share portfolio inside Super, it adds up, and it's money that's simply unavailable to you while you stay in accumulation. Reason 5, though, is the one I think about more than any other, because it's about what happens after you're gone. When most people think about their super, they think about what it does for them. What I want to talk about now is what it does, or costs, for the people you leave it to. If you pass away with your super still in accumulation and you leave it to a spouse or a financially dependent child, no tax is owed on the death benefit. That's worth knowing. But if it goes to an adult child, an independent adult who earns their own income, the taxable component of your super is taxed at up to 17%, which includes the Medicare levy. That can be tens of thousands of dollars gone before your child ever sees it. I don't know every detail of your family situation, but I do know this. If your super is likely to go to adult children, ignoring death benefits tax could cost them tens of thousands of dollars. And most people find out about it only after someone has already passed. Let's go back to Peter. He's got $380,000 in super, and let's say $200,000 of that is what's called the taxable component, money that was put in before tax over his working life, which is most people's super. If Peter passes away at 67 without ever starting a pension, that $200,000 taxable component goes to his adult kids at 17%. That's $34,000 in tax on what he left them. Now flip the scenario. Peter starts his pension at 61 and draws $30,000 a year. Over 6 years, he draws down a significant chunk of the taxable component. By the time he's 67, the taxable portion remaining might be around $80,000. His kid's tax bill drops to around $13,600, a saving of more than $20,000. He's been living better in retirement and leaving more behind at the same time. Now, this doesn't mean everyone should drain their super as fast as possible. There's a balance, and that balance depends on your health, your family, and your other income sources. But the mechanism is real, and it's worth understanding. So those are the 5 legal reasons. But I promised you a hidden catch, and this is the part most videos skip entirely. Here's the thing nobody tells you. When you move your super to pension phase, your fund automatically cancels any default life insurance and total and permanent disability cover that was attached to your accumulation account. It disappears the moment the switch is made. Your fund doesn't call to warn you. It doesn't send a letter first. It's just gone. For a lot of people at 60, that's fine. If you're fully retired, single, have no dependents, and your kids are grown and financially independent, you may not need that cover at all. For others, it matters a great deal. Let me give you a different example from Peter. Take Sarah. She's 63, still working part-time as a nurse, and she has $300,000 in super with $200,000 of total and permanent disability cover held inside that fund. If Sarah switches to pension phase to stop paying earnings tax, that $200,000 of cover vanishes. She could try to replace it with a policy outside of super, but at 63, premiums are higher and she's paying them from after-tax money rather than pre-tax super contributions. I used to think switching to pension phase at 60 was always the smart move. Then I heard about a case where someone made the switch, lost their disability cover, and then suffered a serious health event 6 months later. The claim they thought they had was no longer there. That changed how I look at this advice completely. Sarah needs to weigh the tax cost of staying against the insurance cost of leaving. If her super earns 7% on $300,000, the fund pays about $3,150 in tax on those earnings each year. But her disability cover inside super costs around $600 a year. Outside super, a comparable policy might run $1,200 a year. So the question isn't just, do I want to save $3,150 in tax? It is saving $3,150 worth losing $200,000 in cover. I can't easily replace. For Sarah at 63, that's a real question. The second thing you lose when you move to pension phase is the ability to make non-concessional contributions. These are after-tax top-ups to your super, capped at $120,000 per year, or up to $360,000 in a single year using the bring forward rule. Once you're in pension phase and have started drawing a pension, you cannot add non-concessional contributions on top of that. If you're planning a large lump sum contribution, maybe from selling an investment property, you need to do that before you switch. And there's a third consideration if your super balance is near the transfer balance cap, which is currently $2 million. You can only move up to that cap into pension phase. If you're close to it, partial pension arrangements may apply, and you'd want specific advice on how to structure that. So before you make any move, 3 questions worth sitting with. First, do you or your family rely on the insurance cover inside your super? If yes, find out exactly what you have and what it would cost to replace it before you do anything. Second, do you plan to make a large after-tax contribution to your super in the next few years? If yes, make it before switching to pension phase. Third, is your balance close to $2 million? If yes, the rules around what you can move into pension phase get more specific, and a licensed financial advisor becomes more important, not less. For most people watching this video, those 3 questions will be quick to answer. But they're the difference between a smart switch and a costly one. So when should you actually make the switch? And how do you do it? I remember sitting at my kitchen table with a cup of cold tea, staring at my super fund's phone number, not quite sure what to say. I wasn't even sure I was eligible. But once I understood exactly what I needed to confirm, the call took about 10 minutes. Here's the process. Step 1. Confirm that you've met a condition of release. The most common one is that you've left or finished a job after turning 60. It doesn't have to be your main job. Any cessation of employment after 60 qualifies. If you've already retired and you're past 60, you've very likely met it. If you're still working, talk to a financial advisor first, because the rules around which pension types are available to you while employed are different. Step 2. Contact your super fund and ask for their pension application form. Tell them you've met a condition of release, specifically that you've ceased an employment arrangement after age 60 and that you want to start a retirement phase income stream. They are required to process this. Under the Superannuation Industry Supervision Act, the CS Act, once you've met a condition of release, The fund must allow you to access your benefits. They typically have up to 30 days to process a pension application. Step 3. If the fund drags its feet or pushes back, you don't need to accept that. Put your request in writing. An email is fine. State clearly that you've met a condition of release under the Superannuation Industry Supervision Act and its regulations, and that you're requesting access to your benefits in the form of a retirement phase income stream. Funds are legally required to process valid benefit access requests. Putting it in writing and referencing the legislation tends to move things along considerably. Step 4. If your fund genuinely cannot provide a pension account or makes the process unnecessarily difficult, you have the right to roll your super over to another fund and start the pension there. Most large industry funds have straightforward pension products with low fees. The rollover process takes a few weeks, but it's worth it if your current fund is an obstacle. One thing worth saying clearly: none of this requires a financial advisor to initiate. You can make the call yourself. What an advisor adds is help with the strategy, the drawdown rate, the interaction with Centrelink, the insurance review, the tax on your estate. Those are the places where personalized advice earns its value. The application itself is something you can do. Okay, let me wrap this up. So let's bring it together. 5 legal reasons to consider starting your super pension at 60 instead of waiting until 67. Your fund pays 0 tax on investment earnings in pension phase. Every payment you draw from your super is tax-free in your hands. Drawing down your balance from 60 can lower your total assets by 67, potentially unlocking or increasing your age pension. If your fund holds Australian shares, franking credit refunds become cash payments instead of lost offsets. And by reducing your super balance during retirement, you reduce the taxable component your adult children could face on a death benefit. That's a lot working in the same direction. But the hidden catch is real. Moving to pension phase cancels your default insurance cover and closes the door on non-concessional contributions. For some people, the right answer is to wait or to restructure before switching. The question isn't whether starting at 60 is smart in theory. It clearly can be. The question is whether it's smart for your specific numbers, your insurance situation, and your family. You don't need to be a super expert to figure that out. You just need to ask the right questions of your fund, of a licensed advisor, or of yourself starting today. Check what insurance you hold inside your super. Look at what your balance might be at 67 under different scenarios. See whether the age pension assets test is even relevant to you. Those 3 steps cost nothing and might change your entire retirement picture. If you're a 60-something Australian trying to get the most out of your super without getting caught by hidden rules, hit subscribe. I go through real strategies like this every week with actual Australian numbers and no jargon. And if this video helped, share it with someone who's about to turn 60 and hasn't thought about any of this yet. Thanks for watching.